We all know that the banks don't loan you money. When you take out a loan, the money isn't coming from the bank. It's actually coming from you. So if banks aren't risking their own money, what gives them the power to deny you? Today we're going to be talking about what justifies a denial, why banks are able to deny you, and also at the same time how to be able to fight against banks' denials. All right? My goal for today is really just to open you guys' mind up, okay? A lot of times we understand that, there are laws put in place that enforces the denials of banks and how to be able to fight against them, but we don't truly understand, how to be able to use them to fight against it. Okay? But I'm also going to talk about how rigged the game is, and the game is not really put in place to for you to win. Okay, it's more put in place for the banks to win. All right, and we'll talk a little bit about that. So stay tuned to the end because we're gonna actually go over how to be able to fight against denials. Okay. Now, before we kind of just get started and kind of dive into it, I want to talk about how banks create the money. Okay, because it's super important to understand how banks create the money before we dive into the reason why they really cannot deny us. Okay, or how you can fight against it, because what I'm about to discuss today is not the fact that they can't deny us, but in order for you to overcome a denial, you'll truly have to break down the system and truly challenge them against the system in order to use it against them. However, there are some things put in place that allow them to be able to deny you. And the most important thing is to understand how to be able to fight against it. Okay. Now, first things first, I want to talk about the modern money mechanics. In the modern money mechanics, it talks about how loans create deposits and how money is created. What they do is they borrow money from the Federal Reserve using our promissory notes as collateral. They give them the money that we ask for, and they're able to fractionalize it 10 times and essentially use that to loan to other people. So if you were to take out a $10,000 loan, they can essentially turn that into $100,000. And what they're supposed to do is loan this out to other people. But what they don't do is they don't loan that money out. Okay, they actually keep all the money. Okay. And the reason why they're able to do this is because a promissory note is an asset, and essentially the bank monetizes it. All right. So it's if you go to, so essentially it's not like they don't need a proof of income. Their proof of income is a promise to pay note. So just think about that for a second. Okay. If they're able to get money by just providing a promissory note, why can't we? Dig me? So if you look at when you look at the Jerome Daly case, and this is an essential piece of information that essentially you know further proves that this banking system is fraudulent. Okay. So in this case, and specifically, Jerome Daly was an attorney in Minnesota and the defendant in an unlawful detainer. Essentially, this was a foreclosure proceeding, okay? And so in this case, okay, versus the National Bank of Montgomery versus Jerome Daly, the bank was seeking possession of a property that it had already foreclosed the mortgage on. The jury decided against the bank, okay? And the landowner's defense had been that the bank had not lent him any actual money, but had simply created credit on its books, and therefore, since nothing of value had been advanced by the bank, it was not entitled to the property that had been given as a security for a loan. Although Daly did not ultimately prevail, this case has been celebrated by many of those groups and this, that, and the third. So let's talk about why it has not been prevailed. It did not prevail because Jerome Daly mysteriously died, okay? The people on the case died. If they never died, then essentially this case right here could truly be held up in court. And again, I'm not trying to give you guys any legal advice, but what this case essentially highlighted, okay, and confirmed was that the bank did not provide actual or tangible money as a loan, which they must do in a consumer credit transaction. The second thing it talked about was instead, the bank created money out of thin air by entering the loan as an accounting entry. All right. And this is also broken down in the federal law. And since the bank never gave anything of actual value, the loan contract lacked validity. Okay. And essentially, for something to be considered a contract, there has to be an even exchange. All right. Now, Jerome Daly actually won this case. Okay. And the judge, one of the key reasons was the fact that the bank never put up actual money, and it confirmed that it simply created credit using Daly's signature. And since the bank gave nothing of real value, the contract was considered fraudulent under contract law. Okay. So the judge essentially ruled that the bank was not actually lending its own money. They ruled that the loan was created through bookkeeping entries, meaning there was no lawful consideration. And without lawful consideration, the loan was unenforceable. Okay. So what happened after this case, and essentially why people do not talk about it or read about it today, even though it's still celebrated, the banks did not want this to be publicized. The reason why they didn't want it to be publicized because it actually revealed some groundbreaking information. Shortly after that, the judge mysteriously died. Okay, not Jerome, but the judge actually died, and some people believe that he was poisoned. The third thing, the ruling was never appealed or challenged in those higher courts. And courts today do not reference this case, even though it highlights the fundamental fraud of the banking system. Okay. But the reason why this case still matters is because it exposed how banks create money from their borrowers' own credit. It exposed that it challenged the legitimacy of the modern banking system. And it proved that loan contracts can be challenged if the bank provides no real consideration. Okay. Now, how it relates to the loan denials is the fact that if banks don't actually loan real money, what gives them the right to deny you? Okay. Number two, banks operate under corporate policies and not risk-based lending. All right. And borrowers should start challenging loan agreements based on consideration. So we'll talk about this, but the whole premise of being able to challenge the denial is you have to challenge the premise or the consideration of the actual loan. Okay. Now to get back on track. Okay. Here are some legal sources that confirm it. Okay. When you look at 12 USC 1831, which is the definition sections, it gives you the definitions of many different terms that we know in the banking system today. But I want to go down to what the definition of deposit is. The term deposit means the unpaid balance of money or its equivalent received or held by a bank or savings association in the usual course of business for which it has given or is obligated to give credit, either conditionally or unconditionally, to a commercial, checking, savings, time, thrift account, which is evidenced by a certificate of deposit, thrift certificate, investment, blase blah. Okay? Provided that, without limiting the general term of money or its equivalent, any such account or instrument must be regarded as evidencing the receipt of the equivalent of money when credited or issued in exchange for checks, drafts, or for a promissory note upon which the person obtaining any such credit or instrument is primarily or secondary liable for a charge against a deposit account. Okay? It's a mouthful, but it breaks down what essentially term deposit is: unpaid balance of money. Okay? So essentially, if you have a deposit and the bank is, it's literally saying that it's not money, it's an unpaid balance. All right? So for them to say that they're putting money into your account, if they haven't officially if they deposit money into you, it's literally an unpaid balance. Okay? Anybody that says that they deposited something, or if a bank is depositing something, I'll repeat again, is an unpaid balance. If we come to the Black Law Dictionary and look at the definition of loan, it says bailment without reward, consisting of the delivery of an article by an owner to another person to be used by the latter gratuitously and returned either in specie or in kind, a sum of money confided to another. Okay? A loan of money is a contract by which one delivers a sum of money to another, and the latter agrees to return at a future time at a sum equivalent to that of which he borrowed. So first things first is banks don't actually give you money. If they haven't given you cash in hand, then they haven't given you money. They actually deposit the stuff. Okay? So if they deposit it, which is an unpaid balance of money, then they're not really giving you any money. Okay, so it has to be an actual exchange in order for it to be a loan. So if banks don't actually lend real money, why can they deny you? Okay, banks create risk profiles that aren't lending real assets. Okay, and their power to deny credit is more about control and not about risk. Okay, it's the premise of them trying to control you. Okay, and they're trying to control you based on your risk to them. Okay, so we're going to talk about a couple of laws that justify why they can deny you. So essentially, what justifies these denials is the Equal Opportunity Act, the scope of prohibition. Okay, and then we can also talk about 12 USC 1831. Now let's just talk about the Equal Opportunity Act, and essentially how it says is it shall be unlawful for any creditor to discriminate against any applicant to any aspect of credit. And it also says under 12 CFR 10 1002.4 general rules, it says that discrimination, a creditor shall not discriminate against any applicant on a prohibited basis regarding any aspect of a credit transaction. Okay. So, okay, the reason why they are able to justify this is because they legally operate under corporate policies designed to limit credit access. Okay. So essentially, let me just kind of just unpack this real quick, man. Just talking about 12 CFR 1002 and then talk about 15 USC 1691. The reason why they're able to challenge us is for the simple fact that what the Equal Opportunity Act essentially says, okay, what it says is that banks cannot deny you loans based on discrimination, race, gender, age, but they can deny based on credit worthiness, which is essentially a vague term that the banks create and define. They don't really define what credit worthiness is, okay? And if they deny you, they must give you a reason called an adverse action notice. So prior to them denying you, or if they do deny you, then they have 30 days to send you an adverse action notice. Okay. Now here's how banks use it to deny you. They don't just like deny you based off of these things, but they say, hey, we didn't deny you because of discrimination. Okay. We denied you because of your credit score, income, or debt to income ratio. But who controls the credit system? The banks do. All right. And they set rules for what credit worthy means. You dig me? This is why they're able to deny you. Now, this law makes denials look fair, even though the system is rigged to keep control over credit access. Okay, it's only put in place the system is rigged. Long story short. Then, if we dive to the Fair Credit Reporting Act, 15 USC 1681. Okay, it says that lenders must use accurate and fair credit information to decide on loans. All right. Why? Because the banking system is dependent upon fair and accurate credit reporting. Okay. If they deny you based on your credit report, they must tell you which credit bureau they used. Okay. And essentially, you have a right to dispute errors on your credit reports. Now, here's how banks use the Fair Credit Reporting Act to deny you. And this is one of the primary reasons. They say, well, we denied you of your loan because of the negative items on your credit reports. But credit reports are full of errors, and banks know it. So they relied on flawed credit scores to reject people. Even if the bank's money comes from your own credit signature, they still blame you for your bad credit and essentially for denial. Okay? Even if the bank's money comes from your own credit signature, they still blame your bad credit for denial. Another thing we can talk about is the Truth in Lending Act, which kind of ties into what Jerome Daly was talking about. So under the Truth in Lending Act, it essentially mentions that lenders must disclose all loan terms, all right? So interest rates, fees, repayment amounts before approving or denying. It also protects borrowers from deceptive lending practices. Okay, now here's how banks use it to deny you. They say, based on our underwriting process, you don't qualify for this loan at our current interest rate. Here's the translation. We control the rates and we can tweak them to deny whoever we want. You dig me? So this law protects you from being misled, but it also allows banks to reject applicants based on their own hidden formulas. Okay. And under the Truth in Lending Act, I mean, there's so many different sections under the Truth in Lending Act that breaks down into even more subsections. Take your time to actually just take a gander at some of the disclosure guidelines, definitions and rules of constructions, and things of that nature. Another thing we could talk about is 15 USC, 12 USC 1831O, which is prompt corrective action. Okay, just to break it down, what it says is that banks must manage risk and maintain enough capital before issuing loans, and if you are considered too risky, they can actually deny you. So essentially, this breaks down different lending guidelines that they actually follow so that they can manage their risk and maintain enough capital before issuing loans. Okay? So they may say, we have lending guidelines that prevent us from approving high risk borrowers. The translation is that we created arbitrary risk scores to deny loans to whoever we want. Even if banks create money from your signature, they pretend they need to be cautious about who gets loans, and they use this law to their advantage. We also can talk about the Community Reinvestment Act, okay, which essentially mandates financial institutions to actively meet the credit needs of the communities they operate in. Okay, so essentially, they have the obligation to serve all communities fairly, including low income areas, and is designed to prevent discriminatory lending. Okay, so it's just another cool opportunity act. And essentially, how banks use it to deny you is we comply with fair lending rules, but your profile does not meet our lending criteria. In translation, they say we deny loans legally, even if we control who gets approved. Even though this law is meant to prevent discrimination, banks still find loopholes to avoid lending in certain areas. Okay? So the banks will find the loopholes and they'll continue to challenge and they'll continue to make you feel like you're not supposed to be getting loans. And essentially, it's because of all of these laws here that, they use these laws as a smokescreen because the banks aren't truly risking their own money, yet they deny people based on risk. And they create money from your signature, yet they say that your credit worthiness determines approval. They set rules and use their own system to justify rejecting borrowers. And bottom line, these make the system look fair, but in reality, banks control credit access and deny loans when it benefits them. So when you look at, modern money mechanics, you look at the fact that our promissory notes actually allows them to create credit. We look at the Jerome Daly case that actually confirms this, and they don't provide no consideration. If there is no consideration, then a loan technically isn't a loan. Okay, when you look at 12 USC 1831, and they say that deposits are unpaid balances. When you look at the fact that there's all these laws put in place that is supposed to be against discrimination, but they use these laws as a smokescreen to make you feel like that you are not in control. It essentially puts them in control. Okay, and they create different types of policies and risk guidelines to make it seem like they are actually going based off of risk that they are essentially risking at all. Okay, because we created the money, we're extending credit to ourselves. So their power to deny credit is again, it's not about control, it's about risk and using, the Equal Opportunity Act and using, these risk guidelines is just a smokescreen at the end of the day. And they legally operate under corporate policies. Okay, so the game is rigged. I'm sorry, it's rigged. So if you're looking at this video and you're like, well, dang, I want to be able to fight against denials, we're about to talk about that in a second. But the banking system operates on credit manipulation. Okay, because they're the ones who is essentially distributing the credit. Okay, and it's designed to keep you dependent on their approval. So banks approve high risk loans like mortgages when it benefits them, but deny people when it comes to small business loans. See, it's easy to approve people for mortgages because they get a lot of money and they're able to acquire even more money and double dip from those people. But when it comes to small business loans, they look at that as, well, shoot, man, I ain't, you know what I mean? We're going to use these laws against them now. Okay. So here's how to fight back against unfair loan denials. Based off of 15 USC scope of prohibition, within 30 days, at the receipt of a completed application of a creditor shall notify its applicant of its action on the application. Okay, for any adverse action, you want to make sure you demand them of an adverse action notice. Okay, this is not only, you cannot only, it doesn't only say that under 15 USC 1691, but it also says it under 12 CFR, 1002.4 under the general rules section. You want to request validation of considerations. You want to ask them, what did they actually lend? When you start to challenge them on these things and you start to ask them these questions that they cannot answer, this puts you in a better position. The third thing, you want to challenge your credit report inaccuracies under 15 USC 1681. You want to challenge the credit bureau so that they cannot have an excuse to say that you have negative items and try to use all of these smokescreen laws against you. And then number 4, you want to file complaints with the CFPB or consider legal action if they do not comply properly. And then number 5, you want to use the right legal arguments, okay? Banks operate under contract law and they need valid consideration in order to enforce contracts. So the whole premise of everything is to challenge the loan itself, okay? Before you scream and say you're not supposed to deny me, you want to start to challenge them. You want to ask them for the adverse action. You need to know exactly why they denied you. And yes, you can say, well, this stuff is not a factor, but after that, you need to make sure you ask for validation of consideration. Okay, you want to make sure that you are challenging if they're actually lending. Okay, before you get upset and you say, well, you cannot do an adverse action, you need to challenge whether or not they can do that. Okay, did you guys actually lend me the money? Okay, because when you look at Jerome Daly's case, and it literally talks about how you guys, it confirms the fact that you guys aren't even giving us money. When you look at 15 USC 1681-0, and it talks about how deposits are unpaid money, you know this stuff, okay? But now you can legally ask, did you guys create the money? What was you guys' source of the money? Okay? And the next thing is, in order to combat all of this, going through this entire rigmarole of trying to break down these smoke screens and these legal loopholes, because again, they can say whatever they want because they're really in control for the most part. This is why you have to fix your credit. When it comes to no-doc loans, when it comes to challenging credit bureaus, when it comes to any and everything in regards to, getting funding, okay? You want to make it so that they have no excuse because the game is rigged for them, okay? So if you have good credit, they can't really come up with an excuse of why they denied you. Now it's on the aspect of those other laws and other forms of discrimination. What makes me a high-risk borrower if my credit is good, okay? And you want to take this information and you want to make sure that you're taking proper legal action, because the only way that you can truly enforce these things is if you take them to court. You can't expect them to adhere to what it is that you're asking for if you're not willing to take them to court, okay? And then make sure you are focusing on contract law, okay? Make sure that you're challenging them on the consideration of these contracts. Make sure you are asking them up front, look, man, where did you guys get the money from? If you guys never got it from the promissory note, what are you guys risking if you guys aren't loaning anything at all? Okay, so down below, if you feel like this helped you, let me know. Okay, I would definitely advise you guys to check out these laws yourself. Okay, I'm not sitting here telling you guys that as soon as you get denied, you should challenge them, but hopefully this will give you some perspective of the process and how you must challenge them in order to get them to approve you. And I want you to understand, would you rather go to bat with one banking institution about their denial and trying to prove valid consideration and trying to prove and figure out the adverse action and trying to challenge this, that, and the third and breaking down all the legal back end and trying to overcome all these legal loopholes? Or would you rather just fix your credit in its totality, and after you fix your credit, you won't have to worry about being denied? And if you are denied, it makes your case even stronger, okay? So down below, I have some links that you guys can tap into where you're able to fix your own credit, all right? I also have the no-doc guide, so if you do have good credit, only thing that you would need to provide is good credit, and you can get most of the loans that's in my no-doc guide, all right? And also at the same time, if you need help, book a one-on-one consultation. Let's have a conversation. Let's talk deeply about these things, and I can be able to help bring more mental clarity around everything that I talked about today. All right. If you want to learn, if you want to continue to see more videos like this, like, comment, and subscribe. Put your questions down below, and I'll make more and more videos that can help you guys go and grow. Appreciate you guys, and I'll see you next time.